Alrighty, let's take a look really quickly at 217B. This one should be fairly quick as well. What we're going to look at here is prepaid rent from both perspectives. So prepaid rent from the purchaser's perspective, and then the same thing, except it'll be an unearned revenue from the seller's perspective. So one thing you really got to nail down, and you got to get used to doing, is look for your dates. Look at your dates. What are your dates? How much did you pay? How long is the contract for? So here we can see it's July 1st, right? So that means if our ending date, if the date we report is December 31st, that means we will have 6 months worth of that rent paid for us. Why? Well, because it's July 1st, it's at the beginning of the month, so we have that full month of July that we get to recognize as an expense. So July, August, September, October, November, December, right? 6 months of rent. So that's the first thing we're going to do. How much did we pay? $6,000. It's for 12 months, so 12 is our denominator, right? So let's say we paid $6,000 in rent, prepaid, times how many months did we have it? Well, July, August, September, October, November, December. So 6 out of those 12 months. Okay, so this becomes 36,000 divided by 12, which we know is going to be $3,000, right? So this is for the full 6 months, right? If we were doing it per month, it would be 6,000 over 12, because you've got 1 over 12, and that would equal $500 per month, right? So don't really need to worry about that. No, that would be your per month if we were saying make an adjustment every month. Here we're just saying we're going to make this adjustment after 6 months at the end of the year. That's when we make the adjustment. So that $3,000 is for the full 6 months. Okay. So now we figured the math. Let's talk about what we did. Well, let's go from the Caledonia Corp company. We're the purchaser. We are paying $6,000 for 12 months worth of rent in July. So we have a decrease in cash of $6,000, but we have an increase in another asset, that prepaid rent asset, of $6,000. So we have an asset exchange. There is no impact on the accounting equation, right? So we know there is no impact here, right? Now the adjustment. Do we make adjustments to cash? We do not. We do make an adjustment to this prepaid rent asset, right? I think I told you guys in class, assets, liabilities, they really just represent timing differences in cash flows. That's what they are. They're timing differences in cash flows. Now we're recognizing that with the adjustment. So the adjustment here is going to be negative $3,000. We're going to reduce this prepaid asset account by $3,000, right? So if we look back here, we calculated $3,000 was the total amount of that asset. What we're trying to do, again, you've got prepaid rent right here. This is the asset we created, okay? $6,000. What we need to recognize is we used 6 months of that, or $3,000. Okay, so we're going to reduce this side by $3,000, leaving $3,000 remaining in prepaid rent to use, and we're going to increase the rent expense by $3,000. Okay, now remember, this gets closed to where? It's going to get closed to retained earnings. It's going to be a decrease to retained earnings, just a reminder there. So this is essentially what we're doing, guys. That's what we're doing in this. We are making sure that this account balance is correct. That's what the adjustment is for. We do not want to overstate our assets. That will force us to overstate our liabilities or overstate our stockholders' equity. We're going to run into a problem if we do that. So again, we didn't have any impact on our liabilities. We didn't have any impact on common stock, but the other side of that equity, the retained earnings, we did have an impact on. We're going to decrease that by $3,000. Why? Well, because it was an increase to an expense, which is a decrease to our retained earnings. Okay. Now, the second transaction, we can use the same math. We're just going to flip things a little bit. Okay. We're going to record what happens when we are the seller of that. So we got $6,000 in cash. That was an increase in cash. Have we earned anything yet? No, a month hasn't gone by, so they haven't given us any revenue. we haven't earned any revenue. Okay, so we've got no impact to common stock, and since there is no impact to revenue or expenses, there is no impact to retained earnings. Now, at the end of December, we're going to reduce this liability by $3,000 because we have performed our service. We have performed the duty that we need. Okay, and this is actually going to be an increase in retained earnings to us because this decrease in that unearned revenue liability is an increase in the revenue, which increases net income, which increases retained earnings. So just a quick look at both sides of that. What's happening for both of the companies? Typically, we're just going to look at this company. Typically, we're going to be the company making the purchase, buying the prepaid rent. But on occasion, you will have to recognize that you will sometimes be the company providing the rent. So just a way to look at both of these and see how they differ. So if you have any questions, feel free to contact me. I will be happy to talk to you.